Good morning. What smart investors do before making an offer. And process beats emotion every single time. Most commercial real estate mistakes are made before the offer is written, and not after the closing occurs. Smart investors don't rush. They slow down and verify assumptions, normalize numbers, and pressure test exits before committing capital. Whether you're acquiring retail, industrial, office, medical, or multifamily, disciplined underwriting is what separates long term winners from regretful buyers. So here's the three-part framework smart investors use before making an offer and why skipping any step can cost you dearly. Number one, rent verification. Trust but verify. And asking rents are not actual rents, and pro formas are not current income. And before making an offer, smart investors validate real, in place cash flow and not broker quoted projections. So, what disciplined buyers will verify is looking at a current rent roll versus the executed leases. And look at this lease start dates and expirations and renewal options, but also rent escalations and free rent concessions, but also tenant reimbursements, making sure the triple net accuracy is there. And if there are any delinquencies or payment plans in place. So why that matters. Lenders underwrite actual income and not future optimism. And inflated rent assumptions kill deals at underwriting, or worse, after closing. Number two is expense normalization. Know the true cost of ownership. So seller financials often understate expenses or reflect deferred maintenance. And smart investors normalize those expenses to reflect real operating reality, not historical shortcuts. So some key expense adjustments can include property management, for instance. Even if it's self-managed, you should be budgeting expense. But market rate repairs and maintenance, but also insurance increases post-sale. That's a real thing. But also making sure realistic property tax reassessment assumptions are in there. But any capital reserves, any deferred maintenance that needs to be cured, those are also costs. And why that matters. And underestimating expenses artificially inflates your net operating income, which compresses cap rates and leads to negative leverage once debt service begins. So do it now before later. Number three, exit assumptions. Plan the exit before you enter. Now, smart investors don't just ask, what's the yield? They ask, who buys this next and at what price can I sell it? And before submitting an offer, disciplined buyers evaluate what likely exit cap rates would look like, not today, but tomorrow. Project what the market liquidity for that asset type looks like, but also any lease rollover risk at the sale. And the tenant credit durability is also another issue. So debt maturity alignment with exit timing is another popular topic. But why it all matters. Exit assumptions drive your purchase price discipline. And if the exit doesn't work conservatively, the deal just doesn't work, period. So why this approach wins deals and avoids bad ones? Well, this framework's pretty simple, and it's designed to protect your downside risk, to improve your financing outcomes. But it also builds lender credibility when you're asking for a loan. But it also aligns your expectations before escrow. And really, at the end of the day, it preserves your long-term capital. Now, in volatile markets, discipline becomes your edge, is the takeaway. And smart investors don't win by being aggressive. They win by being precise and patient. And before you make an offer, make sure the numbers survive scrutiny and not hope. So if you want help underwriting, validating rents, or structuring financing before you go hard on a price, that's exactly where we add value. That is it for the day, my friends. Please visit HoustonRealEstateBrokerage.com to figure out how to get a hold of me. Love to talk to you more about your specific scenario. Take care.